When is market volatility likely to increase in 2023? Breaking news for investors. The question on everyone's minds right now is when market volatility is likely to spike in 2023. If you are keeping an eye on your investments, you are in the right place. Let's break down the factors that could lead to increased market fluctuations in the coming months. Market volatility in 2023 has been influenced by several key factors that create uncertainty for investors. One major driver is the actions of the Federal Reserve regarding interest rates. In 2023, the Federal Reserve completed a series of interest rate hikes, reaching a peak around 5.25%. This tightening cycle has led to fluctuations as investors react to the timing and pace of these monetary policy changes. Uncertainty about future interest rate adjustments tends to increase volatility, especially around Federal Reserve meetings or announcements. For instance, as we approach the next Federal Reserve meeting, investors might brace for potential shifts in policy that could impact the market. Another factor contributing to market swings is economic growth and corporate earnings. Analysts have recently lowered earnings growth expectations for 2025 from 12% to about 7%. Such adjustments signal caution about profitability and can lead to pressure on stock price to earnings ratios. This reassessment often results in increased price swings as investors reevaluate valuations. Geopolitical risks also play a significant role in market stability. Ongoing tensions, such as conflicts in Ukraine and the Middle East, along with uncertainties surrounding United States trade tariffs and immigration policies, contribute to investor nervousness. New developments in these areas can lead to spikes in volatility. Moreover, funds focusing on specific sectors or smaller companies tend to experience more price volatility. Their concentrated exposure makes them sensitive to market news or economic changes. Finally, market outlook periods are crucial. Volatility is more likely to rise when investors await key economic data releases, policy decisions, or corporate earnings reports. The approach of major Federal Reserve meetings or the releases of inflation and employment data often leads to heightened market movements. In summary, market volatility in 2023 is likely to increase around Federal Reserve policy shifts, economic growth revisions, geopolitical developments, and periods of concentrated investment focus. Investors should keep these timing factors in mind to manage risk effectively.